Hey guys, it's Kieran. In this video, I'm going to really give some tips and tricks based on how a professional trader's routine for the week greatly differs from an amateur trader. And these are really tips that I've really learned greatly through learning bits and pieces from my own experiences and really processing it to make it easier for you guys to really understand. Without further ado, let's start. So, first of all, the common mindset of retail traders I've noticed across the years is certain things. So first of all, often retail traders say, if I stare at the charts long enough, then I'll get better results. And I can understand where that mindset is coming from, because very often people are conditioned based on previous 9-to-5 jobs, and I myself have worked previous 9-to-5 jobs, and initially going from that to going trading, you need a certain mindset shift. And very often 9-to-5 jobs really force you to work by the clock, as opposed to having an opportunity-driven approach, because you clock in and clock out. But trading is a bit different. Very much it's, sometimes you get lull periods, and sometimes you gain a fine window where there's a huge opportunity. The next myth, of course, is, I don't have enough time to watch the charts. And I hear this a lot. Of course, you do need a certain amount of chart time to really gain experience and to be able to get opportunities, right? But let me tell you this. There are definitely single mothers who are doing 3 part-time jobs who are successful traders and consistently profit every month. They just have to change their routine. Perhaps they might be doing 3 or 4, 5 max trades in a month, but they are still consistently profitable, right? And so, yes, you might not have enough time, but ask yourself, how can I make this trading work for me? And it might be the case you just have to change your trading style. So how do professional traders differ? Well, this is bits and pieces I've really put together from my own experiences, but also understanding experiences from other people. And a common mindset is that professional traders generally ask themselves, okay, where are the areas of interest where the trade is probable? And they generally just let the trades come to them, and they would just put alerts there. So it's like they're kind of a fisherman, because a fisherman just lays the nets out and waits for the fish to come to them. But a hunter generally just chases after the fish one by one, and that's going to be so much effort. But a fisherman just pretty much just does the research, puts the net out, and just chills and watches a whole host of fish getting trapped in the net. Very often when you're sitting all day in front of the chart, you're pretty much going to force setup when the setup isn't there. Because think about it, right? Like if you're constantly watching the chart all day, of course you need to for a certain element. But you have to appreciate that the more you just watch the chart all day, of course you might have a tendency to force setups. It's just human nature. And so my principle now is very much, I do my research, and I put alerts in your key levels, and if there's no alert, no watching the chart. And this greatly pretty much helps to avoid low probability setups as well. First of all, I'm just going to give a general overview, then I'm going to give a specific example checklist that I might use. So Sunday is really key, I think. It's where you're actually looking at the bigger picture. You might look at the monthly, weekly, and daily chart. You might look at, okay, where is Bitcoin headed, or in general markets, where is the bigger picture outlook? And you can, of course, study mistakes from your journal, because of course when you actually go over the mistakes in the previous week, you really help to improve for the next week. And random input equals random output, right? Like if you don't know what you're doing wrong, you're just going to keep doing the same mistakes over and over again. And so specifically, for example, one of my scalping strategies, I do swing trading mostly, but some of my scalping strategies, as for example, by doing this, I realized that, okay, so on average, every time I win the trade, the actual winner takes 4 to 6 hours, but the loser takes 10 hours. Okay, well, if the trade is going alive for more than 10 hours and it's still no actual progress, then maybe I might close the trade early, okay? And these little fine details I've greatly gained by just constantly journaling. Very often it's quite overwhelming, because in trading, we're trying to improve. We don't actually know the exact way to improve, because the reality is it's such a new industry, and relatively speaking, that there's no set way to really improve, because a lot of people are clueless themselves, right? And so rather than just pretty much just bombarding yourself with so many different indicators, perhaps stick on 3 or 4 that actually work and filter down the details for efficiency. And of course, then you can, once you've done the bigger research homework, you just have to put the alerts. And this greatly makes the preparation for the week significantly easier, because of course during the week, the monthly and the weekly chart aren't greatly going to change, right? It just might be the case of shifting daily levels here and there. And very often, I'm sure you appreciate, the trade is a lot easier to trade when you know the setup in advance. If you've done no research whatsoever and no planning, then when the trade gets to a certain level, then you're naturally more likely to panic. You're more likely to second guess yourself, right? I'm sure you can appreciate. So just a general outlook during the week before I go into more details. So during the week, of course, there's going to be updates to key daily levels, because on a day-to-day basis, price action will change and react across different levels. And of course, you have different sessions, right? You've got London, New York, and you please appreciate that. I understand that, for example, if you're, for example, living in Bali or Indonesia, then naturally you're sleeping when the US market opens. And so you're going to miss a huge chunk of the volatility. And so you might consider, okay, I might just stick to a specific trading session. And that's completely understandable because, of course, it's influenced by the part of the world that you live in. But Sunday preparation ultimately makes the week significantly easier. And going through this checklist, which I'm about to give you, really would perhaps fast track that. So this is an example checklist that I've roughly put a summary. It's not a complete exhaustive list, and you have to appreciate that whilst this is a checklist you can go through to check and perhaps serve as an area for you to do more research, you have to appreciate that whilst you have so much information, ultimately you're going to be pulling the trigger based on certain 3 or 4 checkpoints, in some cases 2 checkpoints. So it's about taking all the information available and efficiently being able to process it to actually execute a trade. So without further ado, the first step I would say is looking at the naked chart. Very often people just miss things purely because they've overloaded their chart with indicators. So first of all, just look at the naked chart. What is the basic price action telling you? What is the momentum of the candles? Are there any support and resistance flips? Then start by looking at the 50-minute and the 1-hour time frame. Okay, so the local price action. Then maybe scale up to the bigger time frame, so 4-hour to daily to weekly. Is the bigger time frame, so the 4-hour plus, is that a trending market or a sideways market? Is the local time frame a trending market or a sideways market? And so when you can kind of get a bigger picture of what the dynamic of the market is, that will greatly influence your trading decisions. And of course, is there any pattern recognition? I will talk about this a bit later. So is there any key harmonics, any key Elliott wave pattern? Is there any key trend lines? Step 2, of course, plan all possible setups, which we've done on Sunday, and we've put alerts at key levels. For example, if you move a certain amount above the daily open, it becomes more and more difficult for the price to sustain that amount of fuel further upwards, right? So you might think, okay, if it moves a certain amount above the daily open, then I might only look for counter trades to that initial momentum for the daily open. Of course, you might consider marking of the previous day high, previous day low. This is, I think, greatly relevant often in Bitcoin as well in crypto, because very often there's liquidity grabs from the previous day high, and on the same day, there's a liquidity grab from the previous day low as well. And often retail are just going in circles. They're just thinking, oh, what the hell has happened? But very often, when you see movements like that, it's just gathering liquidity. Because you have to appreciate that trend lines, I don't just see as a random line of the chart. You have to appreciate that's quite subjective. For me, a trend line is basically a cluster of stop losses. Of course, you can consider marking the previous week low, the previous week high, of course, the previous month and high and low as well. These are all relevant, but the skill is not marking random lines. The skill comes from understanding, okay, is this level still relevant? Has it been tapped too many times? Next thing, so you can look at the local Fibonacci. How does this tie in with the more macro Fibonacci? So you can see how the candlestick patterns react to this key Fibonacci's. Initially, I wasn't a huge fan of Fibonacci, but then when you have so many people using the same thing, it often becomes a self-fulfilling prophecy, right? So volume. So what is a general volume looking like? So you can look at the local timeframes. For example, if there's a double bottom or a bottoming formation, and if there's a volume spike, perhaps you might consider, okay, perhaps the demand is beginning to step in again. Or if it's a local peak and there's a huge volume spike, generally speaking, you want bottom heavy volume because that indicates perhaps more organic run-ups. But if it's like a top heavy volume, that might indicate that, okay, perhaps buyers are just FOMOing in, and that could potentially tie in with another trading strategy, ultimately relying on 2 or 3 trigger points. The beauty is that we have more information, so this is all something you can look at. Next thing, of course, a fixed range. I've talked about this so many times on TA Tuesdays. So you have to draw a fixed range on a relevant sideways consolidation market. You can look at the key value area high, the value area low, so the high volume areas, and you can see, okay, how does this tie with other confluences like Fibonacci, perhaps other metrics like bookmap, order flow, all these things, and the session volume. And I've talked about certain strategies about that as well. For example, the chart has the price action, for example, regained the previous value area low and value area high of the previous day. And there's so many strategies around this as well. Next thing, VPVR. VPVR is looking at the volume of a whole section. But of course, session volume is, and the other thing, for example, fixed range is looking at volume in certain ranges. And so perhaps VPVR has its own use, but in terms of fixed ranges and certain exact specific sections of the chart, it might be a bit less useful. But all these things you can use. And please appreciate that this is just a full checklist of something that I might go through, but you have to realize that you just have to pick and choose what's relevant to you, and you don't have to use every single thing, because you have to realize there's something called analysis paralysis as well. If you're a bit clueless and you're finding it really finding this market really difficult to navigate, perhaps take this checklist and perhaps do research on each and individual one of these things. And perhaps that might help you in your navigation of this market. Next thing, other than metrics, of course, long to short ratio. So for example, markets are designed to really move money from the masses into the pockets of a few, right? And so, for example, if open interest is really going up and long to short ratio is really going up as well, so perhaps retail could be FOMOing in. Vice versa, using this in combination with early open interest can really indicate, okay, is the price action going up because of a short squeeze, or is it going up because people are FOMOing in? And is price action going up perhaps because shorts are taking profit, or is the price action going up because it's actual just FOMOing? So all these things have to be combined, and you cannot take it in isolation. Of course, funding rate as well. For example, if the whole market is net short, and the funding rate, for example, could be perhaps negative, then perhaps the people who are going long would naturally benefit. And so, for example, in conversely, if we're at a local peak, and for example, the whole market is net long, and for example, the funding rate is positive, then if you're actually having a short position and if you actually hold it, you're actually getting paid based on funding rate. You have to appreciate that crypto specifically, and just in general derivatives and crypto, is a very highly leveraged tool. You're not trading the underlying asset, and so there's something to really be wary of as well. Of course, you can use other things like CVD divergences, footprints, delta, bookmap, and order flow, and it's just really taking the time out. You have to appreciate that I cannot just teach you all of this in one video, but you have to really take your time and try these different things and see what suits you. Something to really appreciate is that all these things have their own weaknesses. So order flow, for example, there's a lot of wash trading in crypto, a lot of manipulation by whales just to scare off retail. Let me give you this analogy for certain other things like footprint and bookmap. Imagine you're watching a football pitch. And imagine there are no footballers, but you can see the football being tossed around in certain directions. So naturally, you would assume, okay, well, the ball is going in one direction and there are no footballers. Perhaps the footballers are actually gravitating towards the ball, but you don't know for sure because you can't actually see the footballers. And so that is an example of one information certain tools might use. But another tool, for example, using this analogy, play with me, guys. So another analogy is, imagine you see a pitch, but you see no football, but you see all the football players running to one direction. Well, then naturally you would assume that, okay, if the footballers are all running towards one direction, you would assume that they're running towards the ball, right? So you have to realize that everything has its own weaknesses and strengths, and it's really about, there's no one-size-fit answer, and it's really about seeing, what suits your trading style. And of course, try different things, there's no harm. So in step 6, and this is specifically look at the macro picture, of course I look at certain key EMAs as well, so 1-hour and 4-hour EMAs. I specifically have noticed 21, 55, and 200 are pretty good, and often Bitcoin bounces off the 1-hour 200 EMAs sometimes as well in local price action. Of course, you can look at all sorts of weekly and daily EMAs as well. Often when you're going from a bull market or from a bear market to bull market, often there's crosses in the weekly 21, 34, and 55 EMAs. Of course, you can look at things as well like the 50, 100, and 200 EMAs. Of course, you can also look at patterns as well. I don't personally trade based on patterns, but it can often guide your bigger outlook. Because at the certain times specifically, as a trader, even if you're a scalper, to get to that next level of trading, you have to learn how to hold your positions a bit longer. For example, if you're at a local peak, and if you just got a quick scalp, well, in some ways that is quite idiotic, because perhaps you might close some of the scalp, but then you might convert the rest into a swing trade. And so this bigger picture can greatly help. For example, you might look at key chart patterns, falling wedges, inverse head and shoulders. All these things of depreciation have its own flaws as well, but it's important to be aware of it. For example, a head and shoulder cannot just be a head and shoulder. Sometimes it can be very atypical. It might have 2 heads and 2 shoulders on both sides, or it might have 1 head and 1 left shoulder and 2 right shoulders, right? On other occasions, it might have 1 head, 2 right shoulders, and 1 left shoulder. And so it's just seeing, of course, we appreciate all these things. We have to appreciate that in real life, it greatly varies. And there's so many different presentations. Of course, Elliott waves as well. And you can combine these things with Fibonacci as well. And all these things have a place, looking at the macro picture. And of course, harmonic patterns. You don't have to know everything, but just certain basic ones might be useful for you. Perhaps, for example, the Gartley, the Bat, the Shark, and the Cipher. And seeing just how this ties along with the bigger narrative in chart patterns. Trading, one of the beautiful things is that it also helps investing as well. And so this is basically our edge. And last but not least, of course I've given you a rough checklist, but it's about the processing of this information. That's where the skill comes in. Because at the end of the day, there's so much information available, but are traders consistently profitable? No. I would only say that around 1% to 2% or 3% of traders are actually consistently profitable. And so the skill comes from taking all the information and with enough experience, really understanding, okay, is this information particularly relevant to this time? And so there's a difference between trade entry criteria and trade optimization and confidence factors. Whilst you could have perhaps one or two confidence factors, but the thing is, in that specific time, it might actually be relevant. For example of a false break that I caught, beautiful false break last week from 28.710. At the time, there's a lot of miscommunication, a lot of conflicting information, for example, between CVD divergences, open interest, and other things. But at the time, I noticed this is the basic structure. It was a basic tweezer top, after a very common false break scenario. Then I saw the volume. There's a huge volume spike near the top, and it just indicated to me mass FOMOing in. But other people are just completely paralyzed because there's so much conflicting information. Before this, I actually trained to be a doctor. And for example, it's like COVID, right? COVID-19. There's like certain checklist of things that a person needs to have COVID-19, but they don't have to have all those things. A person does not always come with shortness of breath, high temperature, loss of smell. Some people have nothing and have COVID-19. And so my view is like this in real life, in trading as well. Very often you have all these checklists, but the actual trade setup does not always have to always satisfy all those things. Sometimes you might only get one or two or three tick boxes, and it's often your actual experience in trading that ultimately navigates your trade execution. And of course, you need to assess if it's a high probability setup. And the thing is, if you do all this work and you find that there's no actual trade setup, it's completely fine to sit out. If there's no key level being hit, or if none of your trade criteria has been met, that's completely fine. You have to appreciate that if there's no trade setup and if you don't trade, you're still benefiting because you're not losing money. Somebody else who's impatient will just take useless trades and end up in a negative balance. And as I mentioned before, but from previous risk management videos, if you lose 10% of your capital, getting back to the starting position is not gaining 10%, it's actually gaining 11%, right? For example, if you had a 100k account, getting from 100k to 110k is 10%. But if you lose minus 10% from 100k, that's 90k. But for you to get back to 100k, you don't have to gain 10%, you have to gain 11%. So it actually becomes harder to get back once you've made losses. So that's something to really consider. And so just a quick summary of everything I've talked about. Ultimately, when you actually plan the trade in advance, you just adjustments to your daily habit. And when you actually understand the trade in advance, this greatly improves your trade execution, but also greatly improves your confidence as well. You're already ahead of 99% of the traders. And alerts are your best friend. It also helps to avoid FOMO and helps to avoid useless setups. Because at the end of the day, we're not trying to inadvertently create another 9-to-5 job with trading. Trading for me is basically how to improve my lifestyle. I enjoy things like traveling and other things. My objective in the long run is not just to sit all day and just be a trader. Really to address that mentality of, oh, I'm a trader and therefore I must be sitting at the trading desk and I must be taking trades. This is far from the truth. Trading has to be treated like a business. Some days it's very busy. Other days you won't. But some people, you have to appreciate this, some people are making 3 or 4 swing trades in a month and completely demolishing scalpers who are taking 1,000 trades a month. Next thing, proper preparation prevents piss ball for performance. And I just love this expression as well because it's so relevant to trading. And as touched on before, less is often more in trading. Well, thanks a lot guys for watching. Do check out my YouTube channel. I set this up quite recently and this is where I post like market updates, my passion for crypto, and just tips and tricks really fast to track your investing career. Thanks a lot guys for watching and I'll catch you in a bit.